So I'm Theo Andrew, news editor at ETF Stream. Joining me is Michael Howell, managing director at CrossBorder Capital. Michael, thank you for joining us.
Great pleasure, Theo. Good to be here.
So yeah, let's start. You're going to give a presentation later on at the conference, but maybe we could just start with kind of your broad outlook for bond markets at the moment.
Yeah, I think the short answer is the outlook's not particularly good. We suspect the yields are continuing to rise. We think the US Treasury 10-year will basically test 5.5%, may even go on further than that. The outlook is broadly bad because the US debt situation is deteriorating badly. And we suspect that term premia, which may be a wonkish concept, but they're critical to understanding fixed income markets, are likely to trade higher.
And with that, kind of how are investors in your mind kind of positioned? Are they at the right side of sort of the duration curve, for example, or how are they kind of?
No, I think the answer is that from what we see, investors have got pretty mixed portfolios. Some are anticipating rate cuts. They think those rate cuts will translate into better returns at the longer end. I rather suspect they won't. You've got a headwind of rising term premia and debt continuing to be supplied. At the front end of the market, maybe the 2-year will rally. The price of the 2-year will go up simply because people will factor in some rate cuts from the Fed. I think that's pretty likely. I mean, they more or less said they'll do that, so why not believe them? So I think that's fair. But broadly, I mean, the outlook is one of a steepening yield curve, but not necessarily a great environment. So it's a bearish steepening.
Yeah. And what's your kind of take on when rates might get cut? Are you kind of quite bullish on that?
Oh, well, I'm cynical. I think this is going to be an election event. So I would suspect that the Fed is going to start to flag the fact that rates can come down, and they'll probably put one, possibly 2 cuts in before the election.
That's interesting. Okay. Another sort of point is how Japan's performing at the moment. In your mind, how crucial is kind of how the yen is kind of trading at the moment with all this?
Well, I think that there's a lot of misguided talk about Japan. I don't think Japan is crucial to the outlook for bonds. Clearly, it's not helpful. If yields in Japan are going up, Japan has been a marginal buyer of treasuries, and the Japanese bond market does impact the world for sure. But I think a lot of the effects are exaggerated. And we've been in the camp for a long time that says the yen is likely to be a very weak currency. It's probably part of a deliberate weaponization of the yen against the Chinese yuan, trying to push or make maybe to make the Chinese financial system a bit more fragile. So I think you've got to put it in that context. A lot of what's going on is geopolitics, not really economics. The yen sure is undervalued, but that's not necessarily the criterion here. The yen is being pushed lower, and you just look at the moves that the BOJ have made. I mean, they've been basically pretty soft about the yen. They haven't pushed rates up aggressively, and that's one of the reasons the yen is continuing to trade weakly.
Yeah. And how does that play out in markets, and what should investors kind of how should they kind of be positioned to kind of hedge that or?
Well, I think there's a real risk that the yen could weaken further. I mean, I'm not necessarily that bearish on the yen from here. As I said, we have been. I think that Japanese yields are likely to be pushing up, but that's in the context of generally yields in the developed bond markets rising anyway. The main driver of that is an upturn in the liquidity cycle. Yield curves typically steepen during a period when liquidity is being thrown into markets. And on top, you've got pretty eye-watering levels of coupon supply coming out of the US. And even though the Treasury and the Fed seem to be doing deliberate duration management, they can't avoid the fact that you've got $2 trillion of budget deficits to fund every year, way into the future.
Yeah.
And it will get worse.
Yeah, and you mentioned the debt there. I mean, how big a concern is that, do you think, in the broader picture?
I think it's a big concern. We're in a situation where you've got fiscal dominance, where it's likely there's going to be a lot more monetization of that debt. We're already starting to see that with the increase in bill issuance. I mean, bills are basically being used as the plug to fund marginal increases in the US government deficit. And those marginal shocks are going to get bigger and bigger. So there's a lot more bill issuance. Banks tend to buy those bills, so that's direct monetization. Monetary inflation is something which undermines the integrity of bond markets, but it does support other instruments like gold and cryptocurrencies like Bitcoin. So I think that the more you shift out of treasuries, the more you've got to shift into these monetary inflation hedges like gold or Bitcoin. So go long a gold ETF and go short a TLT or bond ETF.
Yeah, good stuff. Yeah, we'll definitely get to that in a second. You mentioned kind of interest rate cuts being in a sort of an election event. how big an impact will the kind of debt play in the election? Do you think it will be kind of a key talking point, or will it kind of impact policy making?
Well, I think the thing is, in many ways, the Treasury's hands, or the Fed and the Treasury's hands, are tied when it comes to interest rates, for the simple reason that you can't hike interest rates very much now, given the size of the interest bill. The interest bill is already $1 trillion. It's way above defence spending, which is an omen, a nasty omen in itself. So they're pretty much constrained, and the more that you cut interest rates, the more that you stimulate debt. So we're on this sort of roller coaster of debt, which is not a nice place to be. And generally speaking, as I say, the backdrop pretty much to us says you've got to have long-term monetization, which is probably the easy way out for politicians. They'll just kick the can down the road. Are high debt levels sustainable? Absolutely sure they are. Just look at the experience of Japan, or look at Britain in the 40s and 50s. They were sustainable, but they had really bad ramifications for the real economy.
Yeah, and the impact of that, I mean, US Treasuries, does that mean they're sort of junk then in that case?
Well, I don't think they're necessarily junk, but I mean, yields are climbing. They're obviously a lot less attractive than they were. They are still notionally the safe asset worldwide, but they're being challenged by other safe assets, of which I would point to gold and maybe even cryptocurrencies.
Yeah. Is any cryptocurrency in particular? I mean, is it Bitcoin that kind of?
No, I'm not an expert on the nuances of cryptocurrencies, but I think you've got to accept the fact that Bitcoin has proved itself to be, in the last few years, an excellent monetary hedge, a hedge against monetary inflation.
Yeah, and we're seeing that come through, and there's a lot of ETFs now that sort of cover that side of things. I mean, it's becoming easier for investors to kind of professional investors to go there. I mean, do you in that case, do you foresee kind of a big institutional uptake of?
I think unquestionably. I mean, Bitcoin is going up a lot more. People are underestimating what it would do.
Brilliant. Michael, yeah, that's an interesting point to finish on. Thank you very much.
Good. Thanks so much.